All right. Good afternoon, everybody. We are going to go ahead and get started. Welcome to another edition of SFR Talk. I'm Lance Calhoun. I work with our institutional build to rent and multifamily teams here at HomeRiver Group. I have joining me today again is Chris Gross. How's it going, Chris?
Hey, everybody. It's going very well. I'm happy to be back.
Yeah, fantastic. It's great to see you. So today we are going to be going through some market trends that we're seeing out there in the market right now, the major economic factors that are sort of causing those economic trends. And then we're going to talk about some strategies that we're recommending owners and investors take advantage of for their new portfolio and for expanding their portfolio going forward. At the end and throughout today, Chris and I will be taking questions. I think you can just drop them right down into the chat. I think some questions have already started coming in. We'll try to answer those as we go throughout today, and we'll make sure we save plenty of time at the end to go through everybody's questions. So, Scott, I'm going to share my screen now, if that's okay. All right, there we go. So am I sharing, Chris?
Yeah, it's not in
Okay,
presentation mode yet, but you see your screen.
okay. You can see my presentation. Yeah. Okay. Sorry about that, everybody. For those of you who are not familiar with Home River Group, Home River Group is the nation's leading provider of third-party property management services that focus on the single-family, build-to-rent, and multifamily sectors of the market. We provide more than just management services. We are a full-service solution from acquisition, disposition, brokerage. We also provide leasing, renovation, asset management, and other investment management services for our clients. So we're going to start off talking about some of the major economic factors that we have seen in 2025, going to continue throughout the rest of this year and carry over into 2026. And there's a lot of different factors that impact this. We're going to highlight a select few today that we feel are the most impactful and have the best ability to be actionable to work around as these market conditions sort of continue. So there is still some large impacts when it comes to inflation, and we still see interest rates very high. And that is, of course, making the cost of debt very expensive, making it hard for anyone to do any type of new real estate transactions. At the same time, we're sort of seeing some softening in the labor market. I think if everyone saw the recent jobs report, it gave some pause to a lot of folks. And we're also coming off of the heels of some of the largest level of new unit deliveries that really peaked in 2024. We saw a lot at the beginning of 2025, but that's now greatly slowed down, and we're going to see far fewer deliveries going into 2026. We also saw some really good news that a large portion of the new deliveries that we've been seeing are in the build to rent and affordable housing sectors. And we think there's going to be a lot of demand and increase for that, going forward. So let's start off talking about the cost of debt. I think a lot of us are familiar with a symptom of this. It's sort of the locked-in effect that we've seen throughout this year, where if someone was looking to make a purchase previously before interest rates went up, right, they were looking at a certain value asset and a certain value debt service. And now that has changed. For homeowners, they can't go buy a house in a nicer neighborhood. They'll actually have to pay much more for a lesser home than they have now. You're also seeing it on the investment side. You're expecting a certain debt service against a certain rent income, and those rents may have even fallen, right? So all of this has led to a real decrease in demand. That has softened in some markets more than others, but you've seen the demand for housing of all types slow down. You've even seen it apply to rental housing, where you have folks that, I'm going to stay in this rental home because I can't go buy a home, are moving to a new rental. Rental prices have went up the past several years. It would cost me more. I'm comfortable where I'm staying. So this has slowed everything down in the market. It's put a lot of capital on the sidelines. You've seen a lot of developments slow down, a lot of those not get started. And so because of that, that is the supply side in a lot of ways. and plus the demand side that you see, right? So supply and demand is still the major driver for this. So we have a massive amount of supply. With all of those deliveries and the lessening demand, you're seeing units on the market longer, right? So you have a heavy increase in supply. And because of that, rents have really started to slow down. I think throughout the entire country, we've seen less than a percentage in rent increases is the national average, I think, at this year. Some markets have done a little better. Some markets have done far, far worse. And so we are continued to see both supply and demand, heavily impact these markets. Construction deliveries, that's going to continue to decrease because there have not been any starts of merit, not a large volume like you would expect in 2025. And so because of that, there won't be a lot of new units getting to 2026. There will be some folks with an advantage. They have entitled developments that are shovel ready and they're ready to jump in there and get to building. Maybe they come in a little sooner. But that construction deliveries is really going to impact things as they go forward. In the short term, it's a good thing, right? You have less units competing with that existing supply. It should get absorbed even at lower demand. If demand increases, then it can get absorbed even quicker. But we may repeat this cycle, right? We may build a lot of units, have to absorb them, and things slow down and sort of repetitive. Most of the forecasts are indicating a much more level delivery and absorption rate going forward. And so that's a lot of good news. Again, we have seen rent growth, be very difficult. It's not grown. It's been very flat. Some markets have done double-digit decreases. Chris, you have a lot of fun with some assets in Florida and Texas, where we've not seen, a lot of rent growth as it was originally projected out there. But we think that's going to improve. Some markets may see it at the end of this year. And even some of those distressed markets may get a little bit of a lessened trade out, if you will. But some markets are going to do really great next year. Some of it may run over into the next. Some markets may get back to 3 or 4% increases. It's going to be very incumbent on the supply and what comes into the market next. The other thing that is impacting the market in certain ways is legal changes, right? Governmental policy that we're seeing. One thing that Chris and I have been talking a lot about with some of our owners that work on the affordable space is what's sort of happening with Section 8 and the different voucher choice programs. Under the previous administration, I think there was a lot of anticipation that rents voucher amounts are going to be raised. Rents have went up significantly over the past few years, and the voucher amounts have sort of been stagnant. So a lot of people are under rent. The new administration is not going to make those changes, and it looks like they will actually. There's some conversations about potentially pushing that down, to the states to run those programs. So it's really a lot of confusion in the Section 8 program. So as that develops, we'll see how that happens. Chris, I know strategically, you've had to make some changes there for a few clients, right? Where we were
Yeah.
anticipating one thing and now we've had to shift gears, right?
Yeah, absolutely. I think the word of the year probably in affordable and light tech investments has been uncertainty. There are a lot of forecasts, I think, last year and before, and just, they may come to fruition. There may be some things that change, but right now I think we're still in a place of uncertainty as far as that's concerned.
Yeah, and it's interesting too because coupled with some news that came out of the recent Federal Budget Act, there are some increases that should help states fund and build more affordable housing out there in that light tech space, right? So that is one reason I think a lot of people are very very hopeful for new affordable housing that you'll see a good amount of that development happening. So very very interesting that's out there. And we are seeing some different rent regulations and even some rent control in certain markets limiting increases. There's different state and local legislation, in different areas that contribute to that. And something that Home River Group as a team, we because of our scale and presence where we're located, we stay very heavy on top of that. So very interested to see those changes that happen. So what is the good news, right? It's been sort of a rough year in a lot of areas that people had very minimal growth and they sort of had several years post-COVID of fantastic, times. Most of the projections are saying that everything is going to start rebounding end of this year, rolling very heavily into 26 and most likely continuing in some markets, into 27. The timing of that is going to be different from market to market. And even if you get down to a state level, we've seen areas of Central Florida that we think will rebound, 6 months before others, right? And have different rent volumes and increases in there. And the markets are going to be very dependent on that too, right? There's some markets that have had massive amount of deliveries. It's going to take a long time for them to, dig out of this hole, at least with the current conditions. But we're recommending a whole suite of things to owners to try to take advantage of this and investors to try to make good decisions in this time. And for folks that currently have assets out there, you know. And looking to acquire more assets or build or develop more assets, getting prepared for what's going to come next is the key thing. Chris and I, we were recently talking to a guy that's used to rehabbing, 5 homes a month, right? And he's wanting to start rehabbing 20 homes a month. Well, that's a big scale, right? How are you going to make that jump? Where are you going to get that staff? What is your plan for that? And there's a lot of those things that you have to think about. How are you going to invest? It's also time to get things organized, right? You're going to go out and look for deals. You got to think about financing. You got to think about capital. However your investment structure works, be prepared to do that, especially if you're looking to scale up, to the next level. So here are some of the strategies that we implement and we've been recommending the owners to really be able to optimize the time that we're in, take advantage of it, and have good planning, going forward. And Chris, I think the number one thing we talk about the most with everybody is defend your occupancy right here and now.
Yeah, absolutely. I think now more than ever, and it's been a theme all year, but really, increase your occupancy, do what you can, but then defend it. Don't give any residents a reason to move out and lower that occupancy for anything inside of your control. Really level up your customer service, level up your tech stack and your user experience, and keep every resident you can. Even, which I think has been unheard of really since before and through COVID. $0 increases are much better right now than even one empty unit. So definitely, defend your occupancy. And also, a strategy we've used is to help us forecast into next year is send out some renewal offers ahead of time. See what your exposure is, see who's moving out, give them an early adoption offer. Hey, if you sign a renewal on your 7 of 12 months into your lease, if you sign a renewal now, we'll give you a $0 increase. Let's lock that in for another, 12, 14 months or whatever your forecast personally is for your property. But that's a huge strategy, I think, too, to allow you to just see what's gonna, see what your exposure is gonna be in 2026.
Yeah, it really is. And that's something it's amazing to see with the focus that, Home River Group has had on that, right? How across the board, single family, multifamily, build to rent, everybody has really increased their retention rates and it's made life, so much better. So, and especially, to your point, Chris, as we documented, there's a massive amount of supply out there. Don't give your resident any reason to move out because there's not a line waiting around the corner, ready to rent that like there was a year ago, 2 years ago, 3 years ago. And then Chris, there's a lot of creativity, right? That you guys have been putting to play, especially, out there on a property level, with how you run specials and concessions and not waiting until, every other player in town has offered a special before you think about it, right?
Yeah, absolutely. And we're back in the, probably been almost a decade, but we're in the concession wars right now. So, the closer to the expiration for a resident, the more they're likely to shop. So if they see a very similar unit, nobody wants to move, but if they're going to get two months up front or something like that, there's going to be a catalyst for them to shop and look. So that's one reason we like to lock them in obviously earlier, but another thing is don't be afraid to offer them a concession to stay equal to what you would offer a new resident. Maybe not 2 months, but what we try to do is really, not lower the rent, but find creative ways to keep them in and still, make their almost their effective rent lower and sell them that way, as opposed to, and honestly, it's probably why some of the rent growth is 1% and maybe actually lower than that, because we're
Yeah.
not the only game in town doing that. But keep them at all costs right now. Not only with the supply and demand, not favorable right now, we're also, on the brink of some seasonality that may affect that as well. So, I would encourage everybody, don't let a resident leave any of your units right now, unless it's a life change, or, hopefully they're building or buying a house, or, a life change that's positive for your residents. We hate vacant units, but we always love when our residents, purchase homes and grow that way. So, if it's not that reason, we want to keep them at all costs.
Yeah, that's right. It's it's really so hard to find good quality residents, right? And in the current market, you be very thankful for what you have in so many ways. So occupancy is also, one side of it, right? The income that it produces and how you optimize that. And Chris, to your point, even if you have to give a concession to that renewal, you're going to give it to the new lease, and then the place is going to sit empty for a period of time until they move in. You're going to make less money. So, think about smart ways of optimizing, cash flow. Cost control though is the other side of things, right? Income and expenses, right? And so we've seen a lot of things during this period of time change. Inflation has directly impacted the cost of goods, right? So maintenance expenses in many ways have cost more. Same thing with a lot of utilities. Insurance is also seems like it continually seems to go up. I feel for our clients down in Florida, that have to deal with the increases that come, related to the storms that they see down there. There's other areas that have had to deal with that as well, right? I think there's been increases related to winter storms in multiple states and all kinds of things. So, there's a lot of things there that you can do to limit expenses from a large scale, but then there's a lot of other things that you can do to be smart, on a tighter level. Chris, one of the things you're doing is being very thoughtful about how we handle lease ups versus stable properties, and how we staff things, according to the needs of the property or the needs of that particular home at that time, right?
Yeah, I mean, a lot of what we try to do is there's not one size fits all. So, look at every deal separately, but the historical 1 per 100 that you've seen on site, right now, if you need to save costs, there's a lot of things you can do with hybrid staffing. If it's a property where, it's large enough where usually you've had 3 people on site, full freight payroll, all the overhead that comes with that, you can shift 1 or 2 of those positions to an offshore, a centralized model where you still have the presence on site, but a lot of people aren't walking into the office anymore. They're chatting through portals. In rare occasions they're calling somebody. But you can get creative. You can have the same headcount, just not physically on site, but you can cut 30 to sometimes 40% of your payroll, still attain the same exact resident experience, still value your residents, but it's a huge savings that we've seen for a lot of our clients that have taken this approach, and really has allowed them to, make deals work, honestly, with some of the debt service that's very high right now.
Yeah, and especially on the build to rent side, because a lot of those are not as large as a traditional multifamily community. We see a lot of build to rent deals that could be, 8 units, 12 units, 25 units. There's all kinds of different sizes that you normally wouldn't see from multifamily. And it's a lot of times hard to make those deals pencil. And to your point, Chris, we're able to make those numbers work because of using this type of methodology. And it's very similar to what we use, for all the single family homes that we have at HomeRiver Group, right? In addition to the multifamily, is you can get a lot of things done centralized, and people are able to better focus on those tasks. And so they're way more effective than putting it, all your hope in just a few individuals that hopefully are good at everything, right? So you get a lot more attention to key areas, out there, and makes a big difference. So that's a really important way to optimize it, and especially for those smaller and medium community sizes, we're able to make a lot of those deals make sense financially for a lot of owners. So that's a very key thing to look at.
Yeah, and I think just kind of one more thing to add that's been a change probably this year is the expansion of LLMs, or large language models. There's been AI chatbots, which really are just a preset answer to about 200 common questions. But I think it was Jensen Huang, the CEO of NVIDIA, said, AI is not going to take your job, but somebody that uses AI is absolutely going to take your job. So, we still hire and we still value all the people on our team, but we've just found ways to make them more efficient, make them more effective communicators. And that's been very helpful to again keep that same level of resident experience, but do it at a more cost-effective approach.
Yeah, and I think we'll talk a lot about some tech things, throughout this chat today, right, Chris? But it's very interesting that you have to stay on the same level of what the consumer is today, right? So however else they're transacting business with everything else in the world, you have to be able to replicate that, or you put yourself at a major disadvantage. And there are a lot of cost savings and efficiencies by using some of these things. Some of the things that get labeled AI are not always AI, right? But to your point, but using a lot of that tech to actually make things easier can save you a great deal of money. And then there's some old fashioned stuff too. Chris, I know we get a lot of good pricing because we use a lot of the same vendors because we have a lot of density and scale in markets, and that's something really a lot of people can do in a lot of ways, right? If you have a lot of scale in a market personally, as an investor, then you can build some of those relationships. If you don't, you can align yourself with partners, like Home River Group, where we have relationships with all these contractors and all these builders and all these technicians out in these markets, and then physical presence, there as well, actual boots on the ground. So that really, makes a difference, and you can save you a lot of money and be much more, cost effective.
Yeah, absolutely.
So the other thing, is to add value in this, right? I think, when I first started in the apartment business quite a long time ago, I worked with a gentleman that said it's all, all four walls and wall to wall. It's all the same. It doesn't matter. We're just renting out boxes, and that has a hint of truth to it, but it's not true, right? There's a lot of different ways to add value that make it much more than the sum that it really is, and finding ways to do that, finding ways to stand out when you have more inventory than a lot of us have seen in quite a long time. And if you don't think there's a lot of inventory, just go open up the app for, pick your favorite. There's Coke and there's Pepsi, right? So you've got the big Zillow ILS stack, and you got the big CoStar ILS stack, and there's dozens of other fantastic advertisers and ILSs that we work with. Go to any one of their websites, and you'll just see the massive amount of homes for sale and for rent out there. So, Chris, we work really hard, right, on trying to find ways to differentiate, to add value, to make that unit more attractive, to residents. One of our favorites is that smart home technology, right?
Yeah, absolutely. I think, currently smart tech is still a differentiator. I don't think in a couple of years that may be the case. I think it'll be the norm, but smart home technology is something that we've used as a value add for our residents. But on the other side, it makes us more efficient. The self-show, the on-demand, you can get groceries delivered on Instacart in 20 minutes. You can get an Uber to take you anywhere in the world. So kind of replicating that. If somebody's driving by your house and they want to see it now, find a way to get them to see that home, to give you a call, shoot you a text, whatever. But it's also, it's an investment in the property. It adds value for the resident, it adds value for your operations, but it also adds value for the property itself. And one thing I think I would encourage, people to do is everybody looks for, rev share opportunities. Hey, if we spend $30 on a smart home, we can charge 50. And that has been the case. But I would even encourage people to roll it out right now at cost. It's another lever when things increase. You can get 3, 4, 5% rent growth, but you can also start to then tick up your ancillary income, add $5 to your smart home package, add a couple dollars here and there, so you can really make up for some of the softness in the market this year. And again, always be on demand. If people want to see your house, don't tell them next Tuesday works for your leasing agent. By next Tuesday, they're going to know where they're moving, and it's not going to be with you.
Yeah, and I think it's like future proofing the asset too, right? To have this technology. I mean, there was a point in time when like Bluetooth in a car was the cool special feature. Now that's all there is, right? Once upon a time, a CD player was really cool to have in a car. You can't even buy a car with a CD player. Who has CDs, anymore? And you can go back and back and back with that. I think it's the same thing for your asset, right? You're going to be at a major disadvantage if you don't invest in improving the tech in the homes, soon, right? And it extends more than just the actual physical asset, right? It's the rest of sort of that tech stack, the experience through technology that prospective tenants and residents have with you, right? And how that actually works. And so, there's probably a lot of people collecting a lot of rent because checks get taken to an office and dropped off at the front with somebody, and that absolutely works. That would really ruin my day if I had to go drive a check, and drop it off somewhere, when I can, pay it on this thing in a couple of seconds. Like, to your point earlier, Chris, like you do every single thing else that you transact, right? And so with residents, because we now use apps for things, having unified apps, right? Being able to pay your rent, pay your utilities, get renters insurance, do all of these things, talk to your property management team, all of this stuff right through one app, right through a portal. It is very valuable. It makes life much easier. Even things that we use on the application side, where they're not having to physically print out a pay stub and take it down to an office. They're able to upload these things electronically, in a very secure way. It makes everything much easier, on the resident. So if you're using, a different tech stack, if you haven't upgraded some of those things, and especially if you're not using self-show tours as a primary way, because believe me, if they're under 40, they don't want anybody walking around with them pointing out, there's the fridge, there's the toilet. Nobody wants that. I don't want that, right? I want to see it, to your point, Chris. If I'm driving by, I want to see it right then and there. And then I want to be able to get on the phone or on text if I have questions and get those answered immediately. That's what the consumer, really looks for today. So all of this tech allows you to add so much value just to make it easier to do business, with the consumer. That's what they're really looking for.
Absolutely.
Um, and then change in the market, right? Uh, it's 2025. It's not 2021, 2022, right? So, Chris, this is something that we're confronted with, or we run into in a lot of different circumstances, right? Where we have to sort of take some old school feeling and throw it out, right?
Absolutely. I think the biggest thing, and kind of back to the smart tech, is don't create barriers to entry for anybody to lease your home. So, I've seen, and I've talked to clients and owners that, hey, we're not getting the rent growth we want, so let's increase our admin fees, let's increase our application fees. Well, that revenue is not going to offset the vacancy loss that it will cause by somebody not paying your admin fees. So, if you have one and it's consistent with the market, it's okay to keep it. But that right now is not an area I would recommend anybody try to get a little bit of ancillary income. Make it as easy as possible to get in your home and become a rent paying resident. And with the self show, and I know we harp on that all the time because I do think it is a great piece. But once in a while, you will get somebody who wants a guided tour. They want to talk to somebody. They want to meet somebody there. So we've partnered with a couple different vendors and national providers that can actually assist in in-person showings at a pretty relatively low price. Instead of a full month for a realtor or something, that they will mimic the exact experience of a leasing agent, but you don't have that full-time overhead of having somebody sit in an office 40 hours a week and
Yeah,
hoping somebody walks in or scheduling appointment the day out. So there's definitely some providers too on that front that can supplement the, maybe 5% of people that
that's right.
actually want a guided tour, without having to pay for that upfront.
Yeah, and Chris, we know that model works. Will work just fine for multifamily showings because that's on the single family side. HomeRiver Group, we've been doing it that way for so long, right? So it's very easy to accommodate. So, be creative. There's very effective ways to get the same thing done and actually give a better experience, to residents. And then, yeah, we're throwing out some maybe old school assumptions, but I think the old school way of doing things, we're leaning into even stronger because of that, right? Especially when it comes to follow up, we're seeing across the board, lower traffic per unit at a time where there's more units, out there, right?
Yeah, absolutely. I think traffic along with demand is down year over year, month over month. We're not getting the same volume of leads that we were a couple years ago. So, again, how do you differentiate yourself? Well, the self-show technology is great. Our leasing agents get an alert when somebody checks into a home, and they call them while they're in the home. If they have a question and they're walking through the kitchen, we're reaching out to them, text, email, phone calls. Hey, any questions we can answer? This if you get 60 leads a month 2 years ago, you're probably going to get 30 leads a month now. So, if you need 5 leases out of that, how do you increase your conversion ratios? And a lot of that is speed. We looked at some data. I think the average renter right now looks like 1.2 homes before they make a decision. So basically, that most people are looking at one. Maybe you'll get somebody who looks at two, but if you're the first one on the phone with them, you're the first one able to build that rapport and that relationship. You have a much higher success rate. So, do some creative things with alerts and things like that, but try to be the first one to call them, build the relationship because unless you give them a reason to go elsewhere, more times than not, they don't want to shop around. They don't want to go to 6 homes anymore. They want to move. They want to move conveniently and make sure you're able to provide that for them.
Yeah, and as we talked earlier, right? Big driver for that's price. Absolutely a big driver for it. And it may be very uncomfortable in the short term to reevaluate your pricing. Chris, we've talked about this where hey, you didn't underwrite it wrong, right? You were right, but the market changed, right? And this is where the market, the market is now. So
Yeah,
um
exactly. And that's kind of another thing is accept the reality of today. You could have the best underwriters in the world and they were 100% accurate when they did it in 2024. But things have shifted. So if you want to sit on that pedestal and say, hey, we were never wrong, well, you probably weren't wrong. You were right at the time, but things have shifted. So make sure you adapt and adapt quickly. It's better to be the first one to lower your rents a little bit than even the second, but definitely don't be the last one to meet the market where it is.
yeah. And then, the other thing that we see right now is with the slowdown in all these construction starts, with the delay and the new supply coming to the market, like we talked earlier, that does mean some opportunity. And it's going to be a little different, for a lot of folks, depending on what you're investing, how you're investing, where you're investing, what the market does, a lot of unknowns, right? But with the way things are forecasted, there is absolutely opportunity for improvement. We are going to see almost everyone is suggesting that we're going to see things improve. Most everyone is anticipating those improvements again, like we talked earlier, end of this year, going over the next year and a half. So how is that going to impact folks? Well, for regular investors, right, that are looking to buy existing product, whether it's single family houses, multifamily, any type of housing that you're looking for, townhouse communities, build to rent, you will be seeing rents start to increase, right? And hopefully, Chris, you had an interest rate watch update for us. There's some rumors we might get some interest rate reductions today, right?
Uh, everybody's that's what they're saying. I think the Fed is currently wrapping up their meeting. So, as we wrap this webinar, we may have some news on that front, which hopefully will be optimistic. I think everybody's saying about a quarter point, but some are pushing for a half a point. So, we'll see. And that'll take some time to work its way through the market a little bit. It's not going to change at 2:01 this afternoon, but
That's right.
hopefully it's some positivity at least on that front.
And if it doesn't happen, then you can just tell everybody Chris and I jinxed it for the whole country.
This is
So
not financial advice.
yeah, that's yeah, that's right. Don't go to what is it, Poly Market and
But
place a bet. Yeah, on anything Chris and I have said here today. Under any circumstances, if you love your money, don't do that. But what you will see with the projected recoveries, you are going to see some opportunity, right? Deals will start to make more sense. Things will pencil in a little bit better. You for existing inventory, you may be able to increase some rents, right? You may be able to get some more scale in some of those markets. because things are going to improve, and because they're eventually this current supply that's out there is going to get absorbed, right? And so there will be need to be new supply to replace it. If you're looking at building and doing new construction and doing development, this is probably the time to get ready to stick the shovel in the ground. I was at a conference recently, and a couple people remarked, whoever gets the shovel in the ground first in the particular market when it starts, like that's who wins. So do everything you can to get that prepared and get that ready. If you're developing land, start that entitlement process, get it up to that point. If your land is shovel ready and you're just waiting to get going, make sure you've got your financing, your capital in line, that you've started, working with construction partners, that you've started working through a lease up and a marketing and a branding plan and all of these different services. So it's really the time to jump in there and start getting prepared to move that forward. And go from there. So, okay. So, Chris, we have looks like we do have a couple of questions. So let's go ahead and jump in. Based on the market, when will be the best time to sell single family rental? So it would definitely be based on the market for sure, right? And a lot of other factors that would come into that, what your financing looks like, what tax implications would be, of selling that. So a lot of things would come into it. It's going to really heavily depend on what's out there. I personally think this would be for me, more of a time to buy. But there's always a good exit strategy, and you should always have one and update that. If you want to reach out to myself or Chris, we can give you some specifics, on individual markets. If it's in a particular market, we can tell you what the market looks like there, what kind of trends we're seeing on rents and income and some of those things. And we can definitely get you with somebody from our team that can tell you, here's how you might make more money, renting it out, right? So we'll absolutely love to talk with you on that. Um, do you anticipate multifamily oversupply in the coming years? Um, yeah, so multifamily tends to do that, right? Multifamily tends to just build a massive amount of units, and it takes a while to absorb those. And some of that's the nature of multifamily, right? Everyone trying to strike, when the iron is hot. There have been, at least in the short term, right, recently some oversupply on some deals, and there's some deals out there with adjustable rates that may not be doing as well. So I do think there will be some opportunity, some people looking to exit some multifamily deals over the next couple of years. I think strong markets, because we still are in a housing shortage, right? So we desperately still need units. I think there will be some good opportunities to pick up some units, and especially do some value add, in a lot of those areas. Again, market to market. Again, reach out to Chris and I, and we'd love to, share some more information. If there's some particular markets that you're looking at, we can sort of tell you what we're seeing there with, the multifamily stuff, and build to rent and single family as well. But context to your question, the multifamily, sort of how it's looking, what we're anticipating. Because it's a very loaded question, right? So there are some markets, for example, where you may have seen some negative impacts of some immigration changes, and it may cause some opportunities in those markets, right? There's some other markets where you have an oversupply of studios and one bedrooms in an urban area, and the demand is for larger units, and there may be some opportunity to go in there and do that. We've seen some folks have a lot of success with hotel conversions, and there's people looking at office conversions. So there's a lot of different interesting things out there, on the multifamily side that we see. So, do we have info regarding regional supply and demand trends, East Coast by West Coast by states? Yes, we absolutely do. It's going to depend from market to market what kind of data we have. We get data in a few different ways. There's several national providers and accumulators of data for housing that we get it from. We also at HomeRiver Group have a very massive portfolio in 30 plus states and 60 plus markets. So we have a lot of our own data. Specifically, in addition to that, on the multifamily and build to rent side, we participate in data sharing with several national institutions, including IRM and the National Apartment Association and some of those others, where we get a lot of market benchmarks from that as well. So we do absolutely have that data. We could tell you, for example, for Atlanta, Georgia, what the delivery and the absorptions have been and what they're projecting going forward. We could even dial that into if you just wanted to see, Fulton County versus Clayton County versus DeKalb. We could do all of those things as well. If you just wanted to see how are 70s garden apartments in Marietta doing versus the 80s garden apartments down in McDonough, right? We could actually dial in and talk through some of those things. So um please feel free, myself, Chris Gross, either one of us reach out. I'm L Calhoun at HomeRiver.com. He's C Gross at HomeRiver.com. Feel free to shoot us an email and we'd be happy to talk to you about some data and some things in that market. So from what you're seeing, do you think we're at a point as an industry where it makes sense to sacrifice rent growth for occupancy? From what you're seeing, are customers more likely to respond to a one-time larger concession or a lower monthly rent? Those are fantastic questions. So Chris, do you want to sort of weigh in here? I think you're pretty passionate about the sacrificing rent growth for occupancy in particular.
Yeah, I mean, I think the first question is caps, all caps. Yes. Right now is occupancy. I think the second question is a little bit more nuanced and it would depend a little bit market to market. I would always encourage you to shop around, see what your competitors are doing, just like a prospect would. Go on Zillow, pull up everybody in your area. What do they offer, and how can you differentiate yourself? How can you make yourself look more attractive than they do? I think, if I had to pick one, I do think the barriers to entry as far as leasing are always good to overcome. So an upfront concession does really alleviate that. But a lot of, and actually in some of our higher end properties, with very, very expensive rents, we actually see where people are, they budget a little bit more closely, maybe. They prefer potentially a lower rent than an upfront concession, whereas some of the lower stuff, they prefer the opposite. So it really is dependent on your property or your portfolio. But definitely kind of do a little bit of both and assess the market that you're operating in and see what it demands.
Yeah, it's sort of tough on our industry. I wish we could be like the car companies, where they put an ad on TV and a $90,000 car drives by and down at the bottom it says, base model starting at, 29.99. And it's like there's no way that car is $29,000, right? That's because it didn't have doors and it doesn't have wheels or whatever, right? It's not, so we don't always have that advantage. So I say all that to say is, you do want the price attractive, right? Because they're going to see that price first. They're going to search off that price first. So I do like to see the pricing be in line. And then those concessions, to Chris's point, it's very driven by the market and what people are looking for. It's not has nothing to do with income or any of those things. It's really, market based and how it all works out. So you have to sort of be creative and pick the one that works the best. So um are we accepting applications with lower FICO scores in this current weaker market? What's the lowest FICO that you recommend accepting? So we have been fortunate that we have not lowered, any of the credit score percentages. I think across the board, we constantly, as a company, are reviewing and evaluating, market to market, right? How we think things should go, community to community. Some of our owners have different direction on how they want to see that done, right? But generally speaking, that has not been something that I've seen a lot, even outside of us, where people have really cut the credit score. Um, I, my sort of opinion, when there's less traffic and more inventory, is instead of lowering your standards, try to come up with some differentiators, right? Try to come up with some added value thing just to get the best ones that you possibly can. That's the best way to do it. That's not always possible. But we try to keep those credit things right in line. That being said, there's other things that you can do as part of the application and evaluation process to make sure you're being smart and looking at the whole total application to get people moved in. So and especially if you're giving concessions. um there's nothing worse than giving somebody a 2-month concession, and then month 5 you're kicking them out and they've never paid any rent. That's not a good thing.
Mhm.
Which cities have been impacted with lower rents or higher inventory of properties in the market? My properties in Missouri. Is this state impacted with negative impact? So I will say Missouri and parts of Missouri have actually done pretty well. I want to think the Kansas City market, their rents have not taken quite the pounding everybody else has, and they're actually beating national average just a little bit. It's not glamorous, but I think it's like they may have had like 2.1% or something like that. I don't quote me on that. I'll have to look it up. But Kansas City in that market seems to be a little more stable and done a little better. Um, some of the markets that we've seen that have been talked about a lot that have really done poorly, Florida and Texas, they've had some negative rent growth that's not been seen, I think, really ever, right? And particularly in Florida. Tampa's done well, not done as well. And some of the areas around Tampa, they've had a lot of deliveries, a lot of stuff built there, and it's been very difficult to absorb those. So some of those markets, have had some little hiccups and little bubbles. At the end of the day, it is Florida, and it's beautiful and sunny year round. So you're going to continue to have demand. This is just a short-term, supply demand thing, and same thing with Texas, right? And we have a lot of assets. In Texas is a massive market for Home River Group, and markets like Austin, depending on whose numbers you look at, it might be double-digit rent loss, in Austin over the past year. But at the same time, Chris, you fully leased up and stabilized an Austin property, during that period as well. You had to cut some rents, but the property, it got to 100% occupancy. So that there's different stories in different markets. Feel free to reach out to Chris or I, or your property manager, one of your BDMs, and they can probably give you some more guidance directly on that Missouri market. But I think it has been far more stable. The markets that have taken the biggest hits are the ones where there have been the most new construction. It's close to 1 million units started and delivered over that period of time. I think 2024 was at least 600,000 some odd deliveries, something like that. And they hit, all right at the same time. So that really, it's the markets and the new growth that took it on the chin the most.
Mhm.
Let's see here. Judy, I'm reading your question now. Yeah, no, it's a good point. So, Judy, you're basically asking if and I apologize if I rephrase this wrong. But basically, if people are staying in their homes longer, right, renters, and they're not moving, shouldn't you have opportunity for rent growth, right? Should be more aggressive, to because it's easier to maintain them, right? So yes, that is providing the retention and being focused on occupancy. That absolutely reduces your risk of turnover because it's not as likely they're going to move somewhere. So that lock-in does somewhat apply to that renter that they were going to go buy a house and now they can't because interest rates have went up, so they're going to stay in that rental home. So that has absolutely positively increased the retention. But what's negative, the retention, what's hurt it is they can rent a similar size and type home for less money if they were to move, right? And that's not universal, and that's not every single asset to every single asset. But that is generally from a market perspective. In some of those markets, there's negative trade out on the leases, right? And if you were to put it back on the market today and rent it to someone else, in theory, that rent would be lower. But that is absolutely not universal, Judy, by any stretch, right? It can very well be that your current resident that's in that home, right? They could be 200 bucks under market, right? And everywhere else they would have to cost them more to move. You can actually raise those rents a little more. So all these statements are sort of assuming like where market rent is today compared to where it was yesterday. So there are a lot of cases where you may need to move people up. There also may be, hey, if especially if it's single family, there's six neighborhoods in this part of town and there's one that's the best and you've got the only house for rent in the best neighborhood. It doesn't matter that there's 20 houses in the other ones, right? Because that's the neighborhood people want to be in. So, that hyper local knowledge of the market is going to make a difference because it's neighborhood level, school district level, what side of downtown you're on level, all those kind of things, right? So it can be very easy that would not apply. And that is something that, at Home River Group, we can help you dial that in and set that projection. But generally speaking, rents have been flat or stagnant, and that's what's helped contribute. And as demand has went up and supply has went up, that's what's helped contribute to lowering of those rental prices. So it breaks my heart to send $0 rent increases. And because we know not because we just want people to pay more money, we know our costs have increased year over year, right? It's got more expensive for us to do everything to provide that housing, and we're just trying to get rents up to where we're mitigating our costs, right? And so it's very hurtful when you have to do that. But we think it's a short term thing, and you may not have to do it, right? If your individual comp set is different, your submarket is different, your very teeny hyper market, you can do things differently for sure. And same thing, Judy. Feel free to shoot Chris and I email or a text, and we'll love to have a longer chat about that with you. What do you think of additional offers for tenants regarding internet and air filter services? That is also a great question. So, internet is a no-brainer, I think, because you're able to give the resident a savings by just doing business with you. For those of you that are not aware, we have an internet program at Home River Group. I think the first, internet and cable packages go back with multifamily a very long time. So we have bulk agreements at almost all of our multifamily and build to rent properties. My internet bill is like 110 bucks a month. But if I was renting from Home River Group, I'd be paying less than 60, I think, for my internet, Chris, something like that.
Yeah,
Um,
probably with faster speeds.
Probably with faster speeds, yeah, because I'm probably cheap and don't get the best package. So I think it's huge, right? It is a fantastic. Everybody's going to have internet. It's a utility, right? And there's a small percentage of folks that don't and rely on their cell phones, right? But generally speaking, people would rather have internet. And the people that rely on their cell phones very often, it's at a necessity, not out of choice. They can't afford 120 bucks every month, for broadband or whatever, right? And so it is a huge savings to them just for doing business with you. And that is something they have to take into account if they ever want to move, right? They want to move, man, I'm gonna lose that amount of money, right? I'm gonna have to start paying more, paying full price, for my cable and internet. So I think that one is a no-brainer. And the air filter thing as well. I hope that every single resident that we send an air filter to, replaces theirs, right? And the cost of that compared to the cost of what your HVAC repairs would be for not changing it is again, a no-brainer. I think it makes a lot of sense to get those filters in the hands of the residents. I know there are some people that throw them away and don't do what they're supposed to do with them. But I sort of have to figure they probably aren't taking care of the rest of the asset either. It's not like that's the one thing that they didn't do, right? And so, you're going to have problems anyways. But I have brand new filters shipped to my house every month, and I love it. It's filter day. The house smells better. It's great. So yeah, we highly advocate internet. We highly advocate the filters. Resident benefit programs, they just make they add that type of value, that we were talking about earlier for sure.
Yeah, that's the one thing
Um,
one thing I would just add quickly is any of those programs, make sure you're adding value. Don't send them a $10 air filter and charge them $35. This is probably the most educated residents I've ever been with AI and the
that's
internet
right.
and all that. Don't, make sure it adds value because that's what they're looking for.
That's absolutely right. That's absolutely right. Is Austin one of those impacted areas? It absolutely is. Austin, Texas has had a massive amount of deliveries in that market over the past few years. Chris and I actually were both in Austin recently. We have a lot of properties in that area, and everybody jokes about how but everybody's from California, right? That's where everybody, the whole state of California moved to Austin, evidently, is the way the way the locals feel about it, I guess. So, it's Austin's a fantastic place. I absolutely love it there. I think that market is going to rebound and turn around. It is a great place to live. I think you just had a massive, massive amount of housing built all in a very short period of time. And because there wasn't there much before, and because you did have a massive amount of demand, right? The supply just finally caught up, right? So that's why you saw a lot of those rents. We have managed to get some properties leased up in those markets. We've done fairly well. But I know one deal that we had there, have there, we from when it was originally underwritten to when the final rents came in, we ended up dropping like $500 to $700 per unit on the something like that, Chris. Does that sound right?
Yeah.
Yeah, to get the rents down and to get the property, stabilized. That being said, it's going to start shifting and going back, the other direction, right? Because it's a great place to live. People aren't going to stop wanting to live there. You get to see the bats. The weather's great. It's great food, great music, great barbecue. We love Austin, Texas, but it has been very tough. I forget how many units they had delivered, but it was an insane amount of units over the past couple of years that have been built and developed there. There's still a lot of construction going on in a lot of areas, especially on the commercial side, and rents, decrease there. Depending on again whose numbers you look at, some people can have them as high as 11% decrease in rent, over the past 12 months there. So, but again, we've got property there occupied, very happy. Everything's great and gonna do better. So, um, good market with a lot of potential for the future. I have a Section 8 property in Pennsylvania. Does an upgrade of property impact the asking rental rate? So it certainly can. It does depend on, what actually you do into it, right? So there's some improvements you would make that would just be bringing it up to, a modern standard, right? And then there's some things that are actually, upgrades. And how that's looked at is going to be different. I would say in the context of Section 8, every area prints a voucher, amount, right? This is how much we'll pay up to, for the different size and types of units. So I would use that as my first guide, right? Because I don't want to over improve things to the point where I'm asking 2,500 a month and Section 8's only gonna pay, 2,100, right? Or something like that. That could cause you some issues. And then the type of things that would raise your market rent, that's the kind of things that I would do and focus on there for sure. And Chris, feel free to jump in there, but low maintenance improvements, appliances, if you were to do remodels, people still want the kitchen's great, the bathroom's great, the appliance is great. I think there's a lot of value in those rehabs, right? The smart home tech, as we've mentioned, Chris, what else would we think would give a lot of value on a rehab house like that?
I mean, I think you named the top ones. again, we can go back to smart home tech and stuff like that. But the other thing I would say is look at the voucher limits and see where you are in that range and how much you can increase it with that investment. Sometimes it, and a lot of times it will make sense. And sometimes it won't. But kitchens, bathrooms, you can't really change the size of a bedroom, but things like that. And again, another savings is the internet. Save them money on the internet, give them a smart home package so they can lower their thermostat when they're away from the house, etc. Things like that I think would add value and aren't super cost prohibitive.
Yeah, I think so. You know, Section 8, the key is passing, as I'm sure you know, that REAC inspection, right? And then in Philadelphia, if you're in Philadelphia, I think there's some additional inspections that you have to do there as well with the city, right? Before you can even do the Section 8. So there's different laws in different towns there that you have to do, but passing those inspections, that's the number one thing. Okay, Vanessa, see your question here. Vanessa is getting ready to retire and trying to make a decision on the condo purchase. And looking to move to Raleigh. Raleigh's great. Go Carolina Hurricanes, right, Chris?
Yep. Oh,
Yeah. Um, yeah, Vanessa, if you would be so kind just to send us your contact info. And what we would do is have someone give you an analysis, on that condo, tell you what we think that it would cost, to rent it, what your income would look like, what your expenses would look like, based off of the location that you're giving. I think I know exactly where that is, and I think we have a lot of assets in that area. One of our senior members of our retail management team, Dale, has been doing stuff in and out of that market for longer than he would probably want me to say on a over the internet in front of everybody. He is a expert beyond expert, and the people that report to him, they know that market better than you could ever believe. So they will tell you what they think they can do there, what that would look like. But that the DC metro area is, another place that, just like we're talking about Florida, right? People aren't going to stop moving to Florida. People aren't going to stop moving, to Austin, Texas. There's places where people are always going to go. There is always going to be demand in the Washington D.C. metro area for multiple different reasons. The large government presence there. So you got all the employment numbers that line right up, and because so much military, there's always people in and out, right? And so that is, I think, another great place to invest is that DC metro area. So please do send your information over, and we'll get our team to give you a need analysis and give you a proposal on what it would look like. Um,
hey, just real quick, Lance. This probably should. I think we're at time. We can do one more, but
okay.
if we don't get to your question, please email and we'll give you a more custom response. But I think we're almost over time.
Yeah, absolutely. Sorry if we're not able to get to the rest of the questions here. We do not charge anything for a rent evaluation. So yeah, there is no cost for us to give you a proposal. So we have multiple different ways of doing things. We are running some different discounts on retail property management services right now. And I think there's even Scott, we're still even running a contest, right?
Yes,
Our
we are,
our
Lance.
Yeah, so there's all kinds of exciting things. So we'll respond to all these questions. And then I also want to let everyone know to be on the lookout for registering for our next SFR talks. You'll be joined by the team at Lennar. They have opened up a rental marketplace, and we are partnering with them on this. So some very exciting things and new ways to get invested into single family real estate. So please join us for the next episode, and we'll look forward to seeing everybody then. And we will be following up with all of your questions. Thanks so much, everybody.